Hello.
Hey, before you do that, or before we do that, I did want to say, try to keep radio silence unless you have a question, because the sound does come through on a lot of the people's hot mics, and
Yeah,
if it
and
does, I'll just
in the
mute
West
you. You
End,
just have to unmute yourself to be able to talk. Okay?
I
Thanks.
did. Yeah, Poro.
Yeah, and like what Void was saying too, if you got a question or there's something you want to comment on or any of that, like drop something in the chat. We're going to be trying to monitor the chat as well, like while we have this discussion, and so we want to make sure that you get heard if there's something that you need to clarify or something that you want to say, something you want to add. So just drop it in the chat, and then we'll unmute you. Void will let me know, or I'll see it, and then we can make sure to make space for that. So super excited to be here with you guys. We've done some other live sessions before. We did the full ICT 2022 mentorship book study, which was a fun experience. But today I got Void here co-hosting with me as well. So pretty excited. Hopefully we can bring you guys some more of this kind of content, whether it's for everybody or just for the premium members. I think that there's lots of different things that we don't discuss on a day-to-day basis that can help make us better traders. And so happy to bring that to you guys today as we talk about consolidation, range trading.
And
Okay.
while on that, if you hear anything today that you want to go over again in another session like this, risk management, stuff like that, we want to dig into that kind of stuff. I know some folks had talked about selling options, covered calls, selling puts. We can do that as well. So keep those things in mind for future live sessions, and we're happy to do those.
Yeah, absolutely. So I'm going to go ahead and share my chart with you guys. But the topic of discussion today, and this was brought by Aquazar. He's not able to be here today, but he said he was talking to me the other day, and he said, "Hey, Rustic, like we've just been consolidating for weeks. Like how do you trade this when it just chops all the time, right?" And it can be difficult and it can be frustrating to traders because although Tesla still has some decent price swings, it's like there's no trend to follow. We have conflicting trends. We have the descending resistance line, we got the ascending support line, and we're stuck in this triangle, right? And not every time do we push up to the resistance trend line, and not every time do we push down to the support trend line, right? And so there's still lots of opportunity to make money, no matter what time frame you're looking at, if you understand how to trade consolidation ranges. Right, so what I got pulled up here is the daily chart of Tesla, and I'm going to use Tesla just because we've been consolidating for nearly 3 weeks, almost 4 weeks. So it's going to give us a really good example. It's a little bit late to start covering consolidation range, as far as the fact that we're probably about to break up or break down here very soon. But it's still good information because now we have nearly a month worth of historical data that's going to show us exactly how to trade these ranges. Got anything to add, Void, before I show some more things on the chart?
Just to note that you might see some folks in chat actually trading within the ranges. They'll be making like $20 per trade because they're trading the bottom of that range, or sorry, my dog. Or they're selling off at the top, right? So that's also the kind of, we're gonna be talking about the breakup or breakdown, but that's that day trading of shares within the consolidation.
Right. Yeah, absolutely. A lot of opportunity for share trading too in consolidation because there's really minimal risk. I mean, if we break the range low, then you have a pretty easy stop loss. And if you're taking entries when we get down to the lower range or our buy range and selling at the kind of top of our range or the resistance, then it's pretty clear, and you just kind of trade it back and forth and back and forth. We've done it a lot with Tesla on options, and I've seen a lot of share traders doing it recently too. So the first thing we're going to want to do when we're looking at a chart and we start to identify consolidation, right? And what's interesting is you can actually identify that this is a very hot spot all the way back here, right? This is back in March and April. We did not consolidate as tightly, but you can see it's a very popular place. And you can even look back.
Fair value get.
You can you can also look back on other times where we were at the same level. You can see there's a lot of activity around there, right? And so when we start to consolidate, you're not going to be able to identify it necessarily right away, but within a couple days, starting on May 8th, you can see, okay, we're trading right around this same level, right? And then we pop back up, we come back down to it. So when you start to see a lot of candle opens, candle closes, or wicks hitting the same level, you can start to say, okay, let's pay attention to consolidation here. And then where you can start to identify it after you draw your level is by dropping down into a 1 hour chart. Okay, and the 1 hour chart is where I've been using an order block. And if you don't know what an order block is the highest up closed candle before a trend reversal down. That's going to be a bearish order block, okay, because it's an up close before the trend reverses down. And then a bullish order block is the lowest down closed candle before the trend reverses to the upside. And so I have an indicator that gives it to me, but you could manually chart it as well. It doesn't matter. And you can see we're given this order block, and we don't have to wait for all of this price to develop before this order block was given to us. This order block was given to us, even though the order block was created May 16th. That order block was given to us, somewhere between May 16th and May 17th. So that's our first return to that order block. And I believe if we went back and tracked the simulated callouts, we probably were taking calls on that first return to the order block, right? And then you see that we dip back down to it. Well, that second dip into it makes that a stronger support, right? Every time we dip back into it and we don't close below it, that support becomes stronger and stronger for the case that we're more likely to hold this level and then continue to the upside. So once that order block's identified and we've tested it once or we've tested it twice, we can with pretty good confidence say that when price returns into this order block, that we want to take a long position. It's a low risk trade, right? Even though it's options, and options are still going to lose more than shares. If you're looking for price to come back down into this 174 and down to this level of 173, basically, right? Your risk is somewhere between, $2, $1.50 on the movement of price, which, however that calculates based on an options contract with Delta, that's going to basically calculate your risk. But we would look, if we used our long position tool and said, every time that price, hits this level, can you guys see that green and red box? Okay, so if we said every time price comes back down and hits this level, we're going to enter a long position. And we're going to set our stop loss at the bottom of this order block or just right below. Okay, but where are we going to target? That's the next question. Okay, and so I like to take a 2-to-1 risk reward ratio on almost every trade. And I often calculate that either based on a block, and I'll put the stop loss below the block or above the block if it's a short. Or I'll calculate it based on where I know liquidity rests to the upside or to the downside. So say we don't see any of this price yet right here, right? Then we could say, I'll take a level, right? We have a couple different levels. You could take that one. You could take that one, right? Couple different levels you could take. That one's about the same. So you could say, these two levels could be your targets, right? Because we're let's say we're buying, off that bounce, that return to the order block there. So we'll kind of shrink it in here, and we're going to say we're going to target that liquidity. Well, that's a 1.76 risk reward ratio. Not bad. It's pretty close to 2. It would be your minimum objective target on a move up. If we took the second level of liquidity, it's a 2.52 risk reward ratio. That's pretty good for an options trade, right? Whether you're taking weeklies or you're taking monthlies or something like that. We got 2 different levels that you could target. If you took a lot of 10, you could close 5 at the first target, the other 5 at the second target, right? Either way, it's good. You see on the first one, we ripped up. Well, if we use that same logic, although we got an additional liquidity target here now in that nice explosive move, we could say, okay, so we profit on that one. Well, the next time we come back down to our consolidation order block, right, our range low, what we're going to do is take that same exact trade, right? So we pop back down, right, into that consolidation block, that order block. We take our entry again, right, and we can target the same exact levels, right? Boom, 1.74 minimum target, second target, right above. You can see on that first pop, we hit our first objective target. We came back down. Maybe you're still in the trade. Maybe you took the quick scalp, right? But then we come back down. We do the same exact thing, right? Entry here, hits order block, right? First target, second target, it hits, right? Here we are again. Returns to that same order block. First target, hit, second target, hit, right? Same thing. Return to the order block, right? On this one, we dipped a little bit lower, but we didn't hit the stop loss. What happens? First target hit, right? So that's your range. You can have some different levels, but ultimately, like, we're going to take the highest high of the range. We're going to take the lowest of the range, and then we're going to kind of set some internal levels in there as well, right? And so when you're also looking at, our order block, even though we have this level down here that we could look for price to come down to, we have an internal range and an external range, right? 2 different levels here. And then we have internal range. We have our second internal range. And then ultimately after that move up, we had a external range above here. And so that's kind of that consolidation that we see as this order block has continued to pay out. Is there any questions so far kind of about this, or any comments that you got, Void?
No real comments, just to know that, ranging can go a long time. It's not like we're talking about just the last couple days, right? As you saw, you can hit these targets anywhere within the range. You'll hear us talk about being range bound. That's because we're not breaking out. We're looking for catalysts to break either up or down.
Yeah. So then I want to go a little bit further. So we got our range, but then we'll pull back out to the daily chart. And when you're charting this stuff, you want to know, because the ranges are great when you're trading them, but you want to know where and how is potentially going to be the next big move, right? Because you don't want to get destroyed when it comes time for the breakout or the breakdown, right? Because we'll be making money back and forth, but just when you think you've got it figured out is the moment where market psychology kicks in and you think, oh man, this has been working for the last 2 weeks. I've been trading this range. Now I'm going to triple up on my position size, right? Because that's just how a lot of retail traders end up getting caught, and that's how they think, right? We look for patterns, we look for things that are working, and it can happen with trend traders too. They're like, they trade the trend. It's working so long. Then they get overconfident. I'm going to put big money on the next play. Boom, you get wrecked, right? So key to know when or how you're going to tell when that breakout's going to occur, because your levels are not enough to confirm that, right? You can see on the daily chart, you can also see on the hourly chart that we had plenty of times where we broke over that internal level, right? If you were using that internal high here, that 179 and a half, and you were saying, oh, if it breaks out of that range, then I'm going hard on the longs, right? And then we only popped up to the next level and then rejected. And so you can't use the range levels specifically as your breakout areas. So that's where we use the trend lines. And so if we pull back out to the daily chart, we can start connecting some tops.
It's perfect sense.
Good.
So we can start connecting the tops and saying, where are our trend lines, right? So we can look at that, and you can draw a couple. There's not anything that you got to do specifically, say like, oh, you got to do it this way or that way. You can just start connecting some different tops, right? So that one's a pretty, not a very aggressive trend line. All right, we're not going to use this low because that was so aggressive that that's going to give us a weird angle. And then you can also sometimes connect these points to other points, right? Something like that, where you can see if it connects to a previous move before we reversed, right? There's some good strength in that as well. So you can take those different ones. You can also drop down into like a little bit of lower time frame and make sure that your points are still connecting the way you want them. Sometimes you can take just a little bit less aggressive line on the hourly chart, right? And we can say when this one breaks out, we're going to look for this next one to break out. That's going to be our confirmation, right? So this could be the fake out on that tight one, but we want to get over that, close above it, right? And then look to push on that next one. Once we break out of that next one, we'll be looking for price to do something like
10%.
right? Breakout. Damn things on white. All right, there we go. Something like that, right? Where then once we break out, it starts running up. So that's where we're using those trend lines, and I've been showing you. And as we start to push up, you can see now we're starting to test the trend lines, right? In the beginning, we were just testing the levels. Then we start to form our triangle, and you can see we're starting to make runs on those as we coil tighter and tighter into that triangle. Now, eventually, that triangle can't go on forever. We're going to see some kind of push up or push down. The reason I've been playing calls so often is because of this order block. You can see on the 1 hour chart, we do not have any bullish order blocks, right? The bullish moves have all gone up to push either above order blocks, close out order blocks, whatever. But the bearish order blocks are not existent. The bullish order block here continues to hold, right? And using other smart money concepts, we have a fair value gap here as well that continues to hold price from going lower as well. So two different smart money concepts, order blocks and fair value gaps, that continue to kind of confirm that we're looking to make that push higher. Now, obviously,
That's where that originates from.
Obviously, nothing specifically says that this order block can't end up getting taken out, right? So nothing specifically that says we won't dump. But that's why we continue to play this order block as our long entry, because it continues to show on our chart as an open order block. So that's our support level. It's a naturally, it just naturally is still there. So until we close that, there's no reason to think that that's not a good support level.
Let's take a really quick pause. We've gone for about 20 minutes. And if anyone has any thoughts or questions about what we've discussed so far, ranging, order blocks, fair value gaps, charting questions, this trading view, Josh's indicators, you can unmute yourself and pipe up or type something into chat really quickly, and we can go over something. We also had some other folks join.
Yeah, I mean, I have some questions. I know you guys talked about like fair value gaps and stuff like that. I kind of watched a little bit of YouTube videos on that, but I was trying to get y'all guys' take on identifying these fair value caps. If maybe like you could identify some on the chart that's maybe right in front of us right now, and then what you would do from there whenever you identify one.
Yeah, absolutely. Great question. So I will just zoom in. This is a fractal. Fair value gaps are fractal. They appear on all charts. They often appear in the same areas on all time frames. They may be different sizes depending on which time frame you're in, but you'll often see like a fair value gap on a 1 hour chart, where also 15-minute chart shows fair value gap in the same area, maybe a little bit tighter. And then 5-minute chart also shows a fair value gap in that area, and then even down to the 1-minute chart. So fair value gap just represents an area where a candle has broken up or down aggressively. And the market algorithm is built to deliver price in an efficient way. And so what happens is that when you have these massive breakout candles, we'll take this one for example. It's the 1 hour candle, May 13th. Nice breakout candle. Okay, so when price pushes up so aggressively like that, the algorithm doesn't have enough time to offer orders back at old prices, right? If that makes sense. So the algorithm is built to book buy and sell trades back and forth, right? Well, if buy orders are coming in so fast, right, at higher and higher prices, the algorithm doesn't have a chance to offer price at fair market value at the lower prices because it's just run up so quickly, right? And so what happens is you get a fair value gap, and the way you identify that is it's a 3 candle setup. So you look at candle 1, you look at the breakout candle, and you take the wick high of candle 1, and this is in a bullish scenario. I'll go over bearish in a second as well. But in a bullish fair value gap, you look at the high of candle 1 and you look at the wick low of candle 3. The space between those 2 candles, or those 3 candles, is the fair value gap. Okay, that's where price has not been able to reprice back into. So oftentimes what you'll see with fair value gaps is you'll see the fair value gap get laid, right? Then you see price deliver back into it, and then you see price run away from it. Eventually, price will be drawn back into it like a magnet. So what we want to see is when we see a fair value gap, what we want to see is price have a willingness to explode out of the fair value gap in the direction that the fair value gap is. So in this case, bullish fair value gap, we draw back into it to try to reprice, and then we go ripping out of it, right? That's ideally what you want to see in a fair value gap. Eventually, price will want to draw back into this to close it, but that doesn't mean it has to happen anytime soon. You can see massive moves happen before eventually coming back down. And some ways you can see that evident is if you look at like how long it actually can take sometimes on a high time frame for us to get back into fair value gaps. Like let's see here. Like there's a fair value gap right here. I mean, there's ones all along the way, but if you look like at this fair value gap right here, right, that's a bullish fair value gap that occurred all the way back in May of 2023, right? And you saw fair value gap. We saw 1 candle dip back into it. We saw price explode, and then we've seen price reprice into it. Eventually, it closed it. 6-7 months later. And so depending on the time frame is going to be more telling of how long it's going to take. Daily time frame fair value gaps could take a really long time to get back to. 1 minute fair value gaps most likely will reprice into it during the same day of trading, maybe the next day of trading.
As you start to watch, and I know some of you are newer, as you start to watch the YouTube recaps every few days, you'll start to identify these gaps yourselves, and you'll see them with the indicators in your charting. I did want to pause and let Siva talk. I'm going to unmute him. A lot of interference there, Siva. You're unmuted on our end now. So Siva, if you've got a question, just unmute and ask it. Okay. Anyone else?
Siva has had audio issues many times in the past during live rooms, so hopefully he can hear us. If not, he'll have to rewatch the video that's been recorded.
Yeah, so are you guys, tell me if I'm wrong, but with these fair value gaps, like you already showed me how to draw them out and how to find them, and that's cool. So you're really just looking for that price to dip back into that fair value gap. So am I correct, or?
Yes, I mean, generally speaking, you're looking for that fair value gap. You're looking for the immediate reprice into it, and then you're taking your position. What's nice about it is it has very clear parameters if that's what you're going to use to trade, right? So I'll just show you here on this one because it's a good example. 50% of the fair value gap is called the consequent encroachment or the mean threshold of the fair value gap. It's the 50% of that fair value gap itself. The 50% levels seem to be very important, no matter whether it's an order block, a fair value gap, a breaker block, which we're not going to go into breaker blocks today. But 50% seems to be where the algorithm wants to reprice to, generally speaking. And that's the best entry point that you're probably going to get. If you hold out for a full retracement into it, it may not happen. Some people take the early entry because they don't want to, they don't know if it's going to reprice to the consequent encroachment fully or not. But let's just use this example. Here's the consequent encroachment, right? If we're trading a fair value gap, we're going to put our stop loss right below in this case, it's a bullish fair value gap. We're going to put it right below the fair value gap close. It's important to note on the time frame that you're trading, you have to have a candle close below the stop loss in order to actually call it a stop, right? I would not put automatic stop losses because sometimes you get wicks that overshoot the low and then rebound aggressively, and then you'll get stopped out and the trade ends up going in your favor. So I usually say candle close below the stop loss on whatever time frame you're using the fair value gaps. But here, right, you get the fair value gap, and then risk reward 2-to-1. Previous high, liquidity will rest there. I mean, you can pick different targets. There's equal highs right here, right, that you could pick as well. There's fair value gaps up here. I mean, there's all kinds of different ways to set your targets. But if you're going to use fair value gaps as entry points, you want to take that immediate dip into it, and then take your entry and then target some kind of liquidity. If it's bullish, you're targeting buy side liquidity in whatever targets you got up here. Or if it's a bearish one, you're targeting sell side liquidity down below. And this works on all time frames. So, I mean, as very, like a sniper type of entry with really low risk. If you use them on the 1 minute or the 5 minute, I'm sure many of you guys have seen me do the inverted fair value gap or fair value gap entries on my trades. And so on the 1 minute or 5 minute, the stop loss is real tight. And so they can be really good entry points if you use fair value gaps. And I can drop down into some lower time frames and kind of show you guys that as well.
No, I get it. Early in the morning, I've noticed Tesla always picks a freaking direction and then shoots up in that direction. So from that big candle or whichever candle it ends up showing first thing within those 10 or 20 minutes, you would draw that fair value gap up and then use that 50% that 50% line of that fair value gap. And would you use that for an entry point to the upside? Is that what you're saying?
Yeah, you could. So, I mean, you're right. Tesla does often shoot up and pick a direction. But then a lot of times it does fully retrace and correct the opposite way. A lot of times that initial move, unless it's a directional day, is like a fake out or a liquidity sweep. And so it's hard to trade the first 15 minutes and call that the accurate information. I usually say if you're going to take, especially on Tesla, if you're going to use the fair value gaps, wait for that initial move to happen. ICT teaches a model called the silver bullet. You'll see it on my charts. I can pop it up to see if I have it. don't think I have it on this chart layout, but anyways, but between market open and the first hour and a half of trading is called the silver bullet. And so a lot of times on the silver bullet, especially with Tesla, you wait for that first move to run on liquidity, and then you look for your inverted fair value gap or your fair value gap entry. And so I'll show you like on today, because our first fair value gap, if you took like the very first one, it was this breakout candle at 9:31 today. If you just drew that across, you would have got closed out. I mean, there is a possibility. I don't have a 30-second chart to see if this candle dropped down. Well, it must have. So, I mean, it still would have worked here. You would have just had to been super quick. Like this breakout candle occurs, we set the fair value gap, we get a wick down into it, and this is why these are sniper entries. Like you gotta know what you're looking for, right? But you grab this entry in this fair value gap, and then it pops up. I mean, at minimum 176.67, right, up to 177.45. So almost $1 move you would have scalped in a 1 minute candle. Right. But then it comes back down and it closes candles below it. So you would have got stopped out. I mean, you would have had to been so fast to grab that one.
Okay. So yeah, you wouldn't be able to use the fair value gaps on like a 1 minute chart is what you're saying. It's a lot harder.
It is harder, and you got to be fast to do it. I mean, I use a lot of 1 minute fair value gaps, but you also just have to like, you get, that's why I almost exclusively trade Tesla, because I've spent years now learning and understanding the patterns of Tesla, how price moves on Tesla, right? Where I can consider myself more or less a Tesla expert on charting, where I feel like if you just jump into any stock or any asset and using the same thing, you may not have the same probability, even though it's still going to work out pretty well. But the more you understand and watch one asset particularly, the more you're going to notice the same patterns and the same kind of behaviors out of that stock, and then you start to develop like your trading style and your how you execute in different things, because there's a lot more than just fair value gap. Like let me find an example. There's something called an inverted fair value gap, which is where like a fair value gap inverts or trades back down through, and that can also be like a good entry point. So you just got to be able to see what is price telling me, right? So here I notice, right, we set this fair value gap, we came up above a level, right, that would have been on our chart or up towards an order block, we reverse down, and we end up closing this fair value gap. On my charts, they become orange. We see this invert, and then we see it draw back into it. So if you were looking to take, a trade on Tesla and you're watching price and you see that inversion, there's our consequent encroachment. We're going to target a previous low. We're going to set our stop loss real tight, right? And you can see we hit it to perfection in a single candle. We almost hit it there, hit it to perfection in that one. Risk reward ratio 13, just because the stop loss is so tight, but the move itself $2 move, so it's going to be about $100 on a single contract if you took that short. So that's one of many tools that are in the smart money concept toolbox. So there's not necessarily one thing that's going to be without a doubt 100% accurate, but the point of taking trades in these very specific and tight areas like fair value gaps, order blocks, breaker blocks, these different smart money concepts, is that you don't have to let the trade go crazy and lose a bunch of money on it, because your stop loss can be very tight, and it'll protect you a lot more than not knowing where to put that stop loss correctly.
Okay.
Does that help?
Yeah, no, that definitely helps. I was just kind of curious. And then I guess my next question was like, I heard you talk about silver bullets before, and from my understanding, it's from 9:30 a.m. to 11 or my time. So it'd be probably different for you. But
That's New York
uh,
time.
okay.
All my charts are New York time.
Yeah, so you would, do you use like any fair value gaps when within the first day? It's like it's your trading day. You wake up in the morning, you wait for market to open. Do you look for those fair value gaps right off the bat at all,
It just
or do you
depends.
use previous day ones?
Depends on the time frame. I mean, I mostly take my entries on 1 minute and 5 minute. Sometimes I'll take them in hour if we're gonna go like further out on the expiration date. But yeah, I do, and what I want to see, what I often look for is like, was there a meaningful fair value gap right before market opened? And when I mean right before market opened, I'm talking like first 30-minute, like the first 30 minutes before market opened. If we saw some kind of large rip or some kind of large dip, that is going to tell me that that's probably a meaningful fair value gap to me. So I'm going to look for price to return to it and see if it catches support, take my entry in that fair value gap. But if there wasn't anything meaningful, like today, there was just this little micro one at 854. To me, that's not meaningful. I did see it return there, right? Kind of returned back into it, faded it, but this is all before market opened, so it didn't mean much, right? And then out of the gate, we closed it down. So at that point, it was meaningless. I'd have to go back and look and see if, for an example of where there was a meaningful one. But sometimes we do. Sometimes we get those pre-market like big fades that's going to give you a good fair value gap, and then it's going to be able to return to it. You could take your short or take your long, right? And then use that fair value gap as your entry. So it just depends. And as you start to learn and practice these concepts, you get more and more familiar with, what is meaningful, what is not, and get more confident in taking the trades based on it.
Okay, yeah, that definitely answers my question. Thanks, man.
Yeah, for sure. Our man's got
Ooh,
oh, go ahead, Void.
I was just gonna ask if there are any more questions before we.
I see one in the chat from Armin.
Okay.
You want to read it out?
The question is, was the put trade from today based on a fair value gap from yesterday?
That's a great question, Armin. And no, it wasn't. What I took that put trade based on was a template that I've noticed, or like I said, the longer you've continued to analyze one specific asset, you start to realize that there are trading templates or price templates that stocks will occasionally display. One of the templates that I have been able to identify with Tesla specifically, and it kind of mimics a template that is in the ICT trading book that we went over during our live trading education on that book study. It's Tesla even shows it a little bit further, but basically it's a directional down day template. Let me jump over into a different layout and I can show you guys how I was able to identify that in today's chart. Where's it? There we go. All right, so we'll take a look at Tesla. We'll take a look at the template from today. So this is the chart I'm normally posting for you guys. It has all of my indicators on, and we will drop into the 1 minute chart. So this shows itself on the 1 minute or 5 minute chart mostly. Now today it faked me out a little bit, and I continued to hold the position because it's on the 15 minute chart. It still confirmed it. But what happens on this, and I think I might have talked about it in today's YouTube video a little bit as well, but what happens is you get your London range. So this is called the London kill zone, right? And most people don't track this because it's a concept unique to ICT, to smart money concepts, and especially to futures traders, because futures are trading 23 hours a day. And so you have significant price action that is happening at certain time periods. But the London kill zone range is basically our pre-market open, right? It's when trading starts at 4 in the morning. And what I've observed over watching this over time is that when we get the London range, the kill zone range, and then we fade that low after the kill zone has ended, and then during the New York session, the New York AM, this is before the silver bullet, this is before the market even opens, we see price deliver to the consequent encroachment of the London kill zone. And then during the pre-market, we continue to fade. What happens is that market opens and we usually run right back up to that consequent encroachment level, and we steal the liquidity that's in this New York AM pre-market range, or this kill zone here. Right? We steal that liquidity, and then we normally have a directional down day. Now, where it faked me out today was that, and like I said, I continue to hold the position because the 15-minute chart confirmed it did not show that this move on the 1 minute chart was going to discredit the template that I saw. But we ran out that liquidity up, and then we continue to fade exactly as I expected, according to how the template's supposed to go. Directional down day, right? Even into the low comes at the New York PM session macro. Even if we bounced, that's where the low comes. So a directional down day is going to be every macro time zone is going to have a lower low. So you see London low, pre-market low, silver bullet low, New York lunch low, New York PM low. So to answer your question, Arman, the put was strictly based on this template that I saw setting up. And I think I entered the put when we made this move up, and then we came back down. It was in profit. I posted in the call outs that, it was in profit, and then it went running back up. I believe I posted it was in profit, if I remember correctly. Either way, this move faked me out a little bit, but if we pop over to the 15-minute chart, you can see in that same area, is it that we had, right, wicks and then wicks, like no actual candles. If you look at where the candles closed themselves, and you look at the London kills or the London consequent encroachment, I'll draw that out as a level so you guys can better see it. But there's the London range consequent encroachment. You can see no candles closed above that level. And so that was my confirmation on the 15-minute chart. That's why I continued to hold that position, even though it was pretty red for a minute. And then exactly as expected, we catch our directional down. Also confirmation of this 15-minute order block too, right? We drew back into the order block for delivery, right? And then where'd we go? We went to the order block below us. So just kind of order block to order block.
And you said, so that block, it's called a London what?
Kill zone?
London kill zone?
Yeah, it was, so, I mean...
And I'll be able to just search that up on YouTube and, kind of, get more information on that, right?
Absolutely. Yep.
Okay.
And I think there's stuff in the education section about how to set up your time frame macros as well. You can Google it. If you can't find it, just let me know. I'll find the YouTube link or send you information about it. And
check the education forum area. There's a lot of infographics in there, but also some text and some links to videos. So you'll be able to see the correlation between London, New York, and APAC markets as well.
Yeah, and I mean, some people ask me why do you call it New York AM? But what the important thing is that because most people are like, why would you even care about this? The market hasn't even technically opened yet, the stock exchange. But why we call it this is because the ICT training is based on futures and Forex, right? It's not based on stocks. I've been able to take all these concepts and package them into trading options, which is not something you often see. And so the reason I'm tracking this is because that is important price action on futures markets, on forex markets, and on other markets. And so that's just the kill zone macro, and that's what it's called. And then it's followed by that silver bullet. And the silver bullet, I mean, if you look back, like there's aggressive moves in every silver bullet. It may not be the biggest move of the day, but there are aggressive moves in the silver bullet, and you can often catch one way, and then you can sometimes reverse it and catch it back the other way. And then sometimes it's just all straight in one direction. But you can see like silver bullet here, 177 all the way down to 172.74. So, you know what, $4 move on that one, right? This one, 179 all the way down to 176. So $3 move on that one. So you get these really aggressive moves. And if you can find an identifier that will catch that move, you know, using again smart money concepts, then you can oftentimes you know, ride a really rapid. And that's the key, is like, that's why they call it the silver bullet, because it's fast. It's not that it's not so much that it's the size of the move, but when you're thinking in terms, especially in terms of options, right? Like when price explodes in a direction, delta starts just going crazy, right? And then if you've ever seen, maybe like you jump into a trade in the first 5 minutes of trading, and like one move will, you know, make that contract go crazy, and then later on in the day when theta's decayed a little bit and the premium's not even as attractive because there's less time or whatever, right? We may see price go higher than it was previously or lower, and you still don't have that same profit as you do when that explosive move happens over 5 minutes or 10 minutes, because theta just starts ramping up and premium starts going up, and then that excitement can fade quickly.
You know, and one of the other things too that you'll see a lot of folks do, and what I would like to do is, when we get that silver bullet, if you size appropriately, you could be done for the day, and you're done before lunch. You're done right, you know, right when the session opens. It's pretty awesome. You also might see other trading groups or other discords. I know there was one where, you know, we were all there together on another discord, some of us, and there were these rushes in the morning for calls. Either a call or a put in the morning, right? Like whichever way it's going. And everybody would get in on that, and they would have their win for the day, right? And they would actually, that'd be their only trade for the day. Whenever we get that set up here, it's pretty awesome. And so you'll see us talking about the silver bullet time frame for that, and just trying to be done before midday. Because the other reason that Rustic's talking about is, you see that New York lunch, nothing really happens a lot of times shortly after the silver bullet until people are done with New York lunch, and then you have the rest of your movement for the day.
Right. You bring up a really good point. A lot of times after the silver bullet ends, you get a consolidation range, whether that was just a straight move up, straight move down, or you get a move up and a move down. You know, we start to consolidate because the excitement has happened. The AM session is coming to an end. You also get London, you know, London market closes right at the time that the silver bullet ends. And so you have the European traders that are just out at that point in time, or heavily out. And then, so you get less market participation, right? And then also just oftentimes leading into that lunch period or even the PM session, we just get less movement. Not in every case, but definitely less participation. And so one more thing I want to cover for sure, and we got about 15 minutes left. I'm happy to go a little bit longer if we need to, but I know it was requested that we take a look at intraday consolidation as well. And so I want to just take a minute to look at how, you know, you could identify that and how you could potentially look for intraday consolidation to be able to trade. And so we were specifically talking about, just a minute ago, we were talking about like the consolidation that often happens right after the silver bullet time macro. So I'm going to turn off some of these indicators so we don't have so much noise on the chart right now. And then we can just, you know, briefly talk about, you know, how to identify those tighter consolidation ranges and then how you would look to trade them. So one example could be found today. Again, oops, I closed the wrong one. So I'm only going to have the silver bullet time indicator up here. And then I got our smart money concepts indicator as well. So what I usually do when I am, identifying a consolidation range is just look for price to kind of bounce back and forth between some levels, right? And then I look for kind of where price hits the same level on multiple times. And then I'll just kind of, draw, a box out. I mean, you can draw it however far out you want, right? And basically say, where's the area where the most candles are being represented, right? And kind of a high and low area there. And what I'm going to look for is I'm not going to do the same thing I'm going to do on like the high time frames with the order blocks. What I'm going to do is I'm going to look for that range to break, because intraday is a little bit different than trading, the high time frames. But you might use the order blocks as well for a little bit of like confirmation that you might be that we might be heading in a specific direction. And so what I mean by that is that we kind of see this range developing here, right? And this is inside the silver bullet. We can look at this range as well in a second. But what I see, and what I would see as prices happening live, is that we get an order block here, right? We're inside of our range. We push back up, right, into that order block a couple times and we reject. We're still inside that range, right? And this is the 1 minute chart. So this rejection of this order block starts to develop a narrative that we're going to push lower, right? So you can take trades inside of this order block rejection with a tight stop up here above these like wick highs, even maybe above that one if you want to be a little more liberal on your stop loss. But what I'd be watching for is I'd be watching for a break up or a breakdown of this range, and I'd be looking to scalp the consolidation, right? And so what I see here is the narrative building that we're going to go lower, and then we push down and we have a candle close below that range. So what I'd be looking for there is to see, are there any other smart money concepts that could tell me or provide me a good entry, right? I could take that next candle right after the break, which would be a fine entry, but I also see that there's a fair value gap right here. So that gives me even more confirmation as we see order block get rejected, right? Price consolidation range break, bearish fair value gap, and we get a 1 candle draw into that fair value gap, sniper entry if you didn't take the break of the previous 1 minute candle, right? And then where can we look for price to deliver? One of our liquidity targets is always previous lows, right? So we could draw out a previous low and you could get a nice little scalp somewhere between 176 and 175 and some change. It's only about a 50-cent move, you could wait to see if it goes a little bit lower. But if you're taking scalps, you could be loading anywhere from 5 to 10 to 20 positions, knowing it's not going to be a really long-term trade. Data is not going to burn you out. And that trade lasts a total of 6 minutes, right? 6 minutes to scalp, 50 cents or so. And the idea with scalping is that you just take more positions and you look to hold for a very short amount of time. And at the worst, you take that trade, you set your stop loss. Right? If you're taking this kind of entry, you set your stop loss just right outside that fair value gap. You target your liquidity. It's an 8.83 risk reward ratio for a 53-cent move if you just go to target. And then when that trade is running in your favor, which it does, you just move your stop loss back to break even and it's a no risk trade, right?
That's pretty cool.
Yeah, I mean, you don't have to lose on that position when it starts running in your favor. And if you do let it go too long and you accidentally, it goes ripping back up another 5 minutes later, well, you just stopped out at break even, no big deal. You look for the next entry. Right? There's no reason to hold those kind of trades for an extremely long amount of time. But that's if your prerogative is to scalp. You got to always know, like, what's your objective? With Tesla, since they're all weekly calls, it's like, sometimes we're holding out for that bigger move because maybe some higher time frames are showing that, price is likely to go this way or that way. And so we might choose to hold it longer instead of taking that quick move. So just
I want to talk about,
yeah, go ahead.
I just want to throw out not a disclaimer, but just kind of like a word of caution too. Trying to trade these ranges and not using a very quick, like active trader type of interface, you can get stuck. You can get stuck at the bottom. You can get stuck at the top. But you need to your broker, your platform. You need to have the ability to very quickly see the price action, watch the trades, basically look at a version of this chart so you can see it going up and down because it's very difficult. A lot of people want to try to just type in a price, right? And then, oh, I'll sell it at 175 or I'll buy it at 172. And you're going to get stuck if you don't have the capability within your brokerage or platform to really be an active trader. I think Webull does that. Thinkorswim does that very well. A lot of the more obscure brokers don't have that kind of software, that kind of platform to where you can do this. The most popular ones have keystrokes. To sell, it's S. To buy, it's B, and to go flat, it's F, and it just does whatever for that symbol. In this case, Tesla, right? You could just press B and it'll buy 10 shares, ride you up, or 10 options contracts while you ride up. When you get to the top, you press S and it sells all 10. Or you press F if you're about to lose. You press F and it goes flat before you start taking on losses. So before you get into this trading inside the consolidation range, uh, and trying to be successful, really look at those type of things within your brokerage.
Yeah, you make a really good point. And another point to that is like if you are going to try to attempt to trade short time frame consolidation ranges, you absolutely cannot make your range too small. Because if you look at something like this, this small consolidation range right here, right, and then you try to trade this breakdown, the risk reward is not good enough. 175.64, we got down here, 30 cents, and then you end up popping back up, you're going to get stopped out, right? You're going to try, then if it's too tight, you might think, oh shoot, we're going to break out, maybe potentially. You try to enter again to make your money back, right? Price then drops down again. So I hear that kind of stuff all the time from traders, like, the market psychology of like, thinking something's going the right way, then you lose money, and then trying to get it back, you go the opposite direction, and then you end up losing money again, and you just kind of get stuck in that revenge trading cycle. And so if your ranges are too tight, there'll be a lot of like false breakouts, false breakdowns, and you'll get trapped in that kind of mess. So you just want to be careful that your ranges are realistic, right?
Yeah. I think too, I mean, for a lot of our crew, many folks are here to trade Tesla or something they're okay with holding. Even, I mean, we've got bag holders here all across the spectrum. So you get stuck in on Tesla. It's not the worst thing in the world. Hey, man. Yeah, me too, buddy. It's not the worst thing in the world to get stuck in one of these day trades on Tesla. You're going to get out of it or get back into it. But if you're trying to trade something else on that lower time frame, that fast paced action, just be careful.
Right. And that's, I mean, a lot of people too ask, like, why do you only trade Tesla, or why do you only trade like a couple of these things? And, another key to the smart money trading concepts is that you have to have something that moves. You have to have something that has a lot of liquidity in the market. Right. Tesla has a lot of liquidity available. There's a lot, high volume trading, and your low volume assets are not going to have the same kind of volatility. It's not going to have the same kind of price movements. Much easier to get stuck in bad trades with those kind of assets. And many of you have noticed too, like when we've ended up in a position that's upside down, there's a very high probability we get back to break even and not take total losses. Now, sometimes I'm a bonehead and don't take that, that break even return, and then we end up taking a loss on the position. But, high probability, like many of the traders who have been here for a long time have seen us go negative and go back to break even or even to positive on some trades that look like they were sunk. And so Tesla's notorious for that, and that's why sometimes we hold those longer positions till Wednesday or Thursday, even though it didn't go in our favor right away.
We're now at the top of the new hour, and we can close up here now, or we can take some more questions. or just break into a general discussion for those who want to stick around. We have about 5 or 10 more minutes. Are there any questions? Anybody just want to chat?
I mean, yeah, I think all the stuff we went over is really awesome. Do you you said that there's going to be like a YouTube video of this discussion so I can go back over it again?
Yeah, so as soon as we get done, I'll stop the recording. It's just going to be the chart. It's not going to be like the Discord part of it, but it'll have our voices and stuff as long as it all recorded correctly. And yeah, I'll post it up on YouTube for you guys. Also, there's going to be a private, well, not private. It's going to be for all the premium members. There is a 6 module education package that I'm putting together. Anybody who's currently premium is going to get it for free. It's something I'm only going to offer in the future for lifetime members. But it's a 6 module education package that is called the Elements of a Trade Setup. It's based on the Inner Circle Traders Elements of a Trade Setup, but it's my own definitions of it. It's going to come with videos, and the traders that I've taught the Elements of a Trade Setup specifically, it's a very precise, setup that you look for. Have had really great success doing it, so just watch out for that too. I'm going to be providing a way for all of you guys to be able to access that as part of your membership now. Void, you're muted.
Cool. Yeah, if nothing else, we can go ahead and wrap up for the evening. Really appreciate everyone joining us, and the questions were great. Throw some questions back out in the chat if you watch the video or want to go over anything else again. We'll handle it. And yeah, anything else to add, Josh?
Nope.
Yes.
Oh yeah, go ahead.
This is Siva.
Yeah, Siva.
I support what White said about the covered calls and anything, and that area is I do a lot. I appreciate we have a discussion on that one.
Yeah, absolutely. We'll plan that for next week or the following week, and we'll advertise it so everybody knows about it.
Yeah, Tesla is getting tough on the covered calls these days. Actually, I made April was bad for me. March is all right. May is okay. Now June is okay. But sometime it is going negative and very difficult to predict the direction and kind of thing. I don't know others. For me, April was terrible.
Yeah, it's been bad all around. I mean, just as an aside, when you look at the yield max funds, they're doing basically covered calls, right? And when they're messing up, you know that you and I are probably going to mess up because they do it for a living. And so it has been a tough couple of months, but we'll go over some strategies and ways to kind of mitigate losses on the covered calls the best we can. And that'll probably be another hour, a 45-minute long session in a week or two.
Okay, thank you.
Awesome.
Yeah, and Void will be taking the lead on that one because covered calls and cash secured puts are not something that the simulated Webull account is able to do, so not something that I have a lot of experience with. So I'm going to let him take the lead when we do have that discussion, and but I will chime in a little bit probably about how you can use gamma levels to potentially place your either your covered calls or your cash secured put levels for the week, or even potentially as your boundaries for spreads.
One more question to Rustic.
Yeah.
I know your callouts are good. Couple of things I made, but I have some problems doing that with my broker now because there is no zero. They have stopped doing the zero Friday calls. 0 day.
Your broker stopped doing Tesla on Fridays?
Yeah, that is same day is out.
Oh wow.
Oh, I know.
Yeah.
So that is the thing. So what I have a question. That's not the issue. Issue is how we can use your call out ones for covered calls. can that be used in any way?
Oh, sure. I mean, like
Yeah.
you can use the charts and the analysis, no doubt. And if you're, if I'm taking puts, a lot of times, people who sell options will take the opposite end of, like, the opposite trade. So if I think price is going down, they'll sell the covered call, up above where I'm entering the put at, right? And even if you're not going to ride it all the way to expiration, you can still benefit from the move down, just like us buying puts will. You'll get the profit off of the covered call. Now, if I'm taking calls, you can take the cash secured put and just ride it the same exact way we take the trade, but you're just on the opposite end. You're selling instead of buying, right? But same analysis. Like if I'm looking for price to go higher, you take your sell based on that same assumption, right?
We'll cover that.
Yeah.
Okay, thank you.
Awesome. Well, thank you guys for hanging out. Appreciate the support. If there's any additional questions, you can send them in direct message, or you can post them into the thread somewhere, and either Void or myself will get to answering those for you guys. So look forward to seeing you all on the next one. Take care and good luck tomorrow.
Thanks again.
All right.
See you tomorrow.
Thanks, guys.
Bye.